Deutsche Bank upping its target from 65.50 to 7,000. That's back to its original forecast from the beginning of the year. And that is now the second highest target on the street. Here with us with his call is Binky Chadha, Chief Global Strategist at Deutsche Bank. Good to see you, Binky.
Good to see you, Mike.
So the path of your target somewhat reflects the way the market has experienced this year, right? I mean, it's like a major scare. We needed to reevaluate a lot of things, tariffs, the economy, the Fed, and the markets, and now we've restored some sense of predictability. So why do you think there's more upside?
That's exactly right. I mean, the way I would put it is basically we had a big shock, or what seemed like a very big shock, the tariffs, and that really upended the market. It upended our views. We were very negative on the impact, but, you know, facts are facts, and so far the tariffs don't seem to be having much of an impact on growth, much of an impact on inflation. Earnings growth actually went in the other direction and picked up in the second quarter. And if you listen to what companies say, they're basically saying that, you know, yes, it's a shock, yes, it's negative, but it's manageable. It's going to grow, but it's still manageable. So we started at 7,000, so we're going back basically to 7,000. I would say forward-looking, key sort of way of thinking about where the market's likely to go is, you know, obviously the market's at new high basically, and so that kind of suggests to most people that everybody's piled in, you know, the market's overweight. Technically, the market is currently overweight, but that's all coming from systematic strategies. So all of the discussion about fundamentals and what we call the discretionary investors, their positioning is neutral, it's hugging neutral for the last 2 months.
Yeah.
That's one source of upside. We have a little bit built in for flows. And then there's buybacks, which is, again, back to earnings. So if earnings are fine, we think buybacks will be fine. You put those three things together, that argues for, as you noted, 8%, and that's back to 7,000.
How do rate cuts factor in? Does it matter if we go 50 or 75 by the end of the year? And I'm just wondering, are the reasons behind the rate cuts, does that override lower rates? In terms of lower rates, meaning, you know, there could be a growth scare. Sure.
So what I would argue is, you know, in terms of our view, it's really based on the macro, and it's really about the growth part of the macro and earnings. So I think rates are sort of important for, you know, rotations and reallocations within the equity market. But I would say, you know, right now, quite a lot is priced into rates already. So it has to be a, you know, a notable surprise relative to that. I would argue it's not the short-term rates, but the more sort of medium and longer-term rates that matter. And they've already priced that in. And if anything, you know, likely to go in the other direction if there's some disappointment. So near term, yeah, I mean, you know, I think it's sort of a sideshow unless it delivers a really big surprise.